Hi everyone, I'm Ara Ogorian with ACap Advisors and Accountants, and welcome to another edition of the ACap Recap, where we go behind the blog and answer some of your most important questions. Today, we're going to talk about how, as a retiree, you can take money out of your IRA and not pay any tax on it. So if you're a retired individual or if you're getting close to retirement, you need to start taking money out of your IRA. Today, we're going to talk about how you can take money out of your IRA and not pay tax on that. However, before we begin, remember to subscribe, like, and share our channel. And if there's a topic you want us to cover, be sure to include it in the comments section below, and we will cover it in a future episode. If you're getting close to retirement or are in retirement and have an IRA, then you probably already are aware of the required minimum distribution, also known as the RMD. The RMD is essentially the IRS saying you've deferred your taxes long enough in an IRA, and now it's time to start taking money out of that account and starting to pay tax on it. Because as a quick refresher, an IRA is either money that you've put into on a regular basis per year and you got a tax deduction for it and it's grown tax deferred, or it's an old 401k or multiple 401k plans that you've rolled over into an IRA, but you've never been taxed on that money. And they've now accumulated in value, and the IRS is saying at some point you have to start taking money out and pay tax on it. That's essentially what the RMD is. And the RMD continues to increase every year as your age increases. So when you first retire, and the earliest you have to start taking RMD is 70 and a half. So even if you are still working and you have an IRA and you're 70 and a half, you have to start taking RMDs. At 70 and a half, it starts escalating every year. So the goal is to completely wipe out the value of the IRA upon your passing. Now the Secure Act changed the age of the RMD from 70 and a half to 72. So keep that in mind. If you don't need the money and you're at that age below 72, you have until age 72 to be able to start taking RMDs out of your IRA. There's a special rule within the Internal Revenue called the Qualified Charitable Distribution. The Qualified Charitable Distribution allows you to donate your RMD, what you would have received as an RMD, directly to the charity. And by doing so, you're avoiding taxation of that RMD, that money that you're going to receive, and the charity is getting a deduction, or the charity is getting a donation that you would have given anyway. So if you normally give charitable contributions and you're also subject to the RMD, you're probably better off, instead of donating cash to that charity, use the RMD through this qualified charitable distribution to donate money directly to the charity. So that way you don't pay tax on that RMD, and you've also helped that charity out. The maximum you can do with a qualified charitable distribution is $100,000 a year. So keep that in mind as you're making these charitable contributions through your IRA directly. A couple of things to keep in mind when you're making a qualified charitable distribution. The first one is, if you do a qualified charitable distribution, then you're not able to take that charitable deduction on your Schedule A as you normally would if you were to donate cash. So if you donated cash or non-cash items, on your Schedule A, you would put on there what that amount is, and you'd get a charitable deduction as an itemized deduction. However, if you do the qualified charitable distribution, then you can't have that both ways. You can't also deduct it on your itemized deductions and exclude it from your income. So if you do a qualified charitable distribution, it's only going to be excluded from your income, and you cannot deduct it again on your Schedule A itemized deductions. The other thing is, when you donate cash and you itemize it on your Schedule A, there's income limitations. So it's usually 50% of your AGI you're not able to deduct. So if your AGI is $100,000, you can only deduct up to $50,000 of charitable distributions or charitable deductions on your itemized deductions. Whereas if you do a qualified charitable distribution, you don't have that AGI limitation that you do with a cash or non-cash distribution. The other thing to keep in mind is, if you're going to go the route of a charitable contribution distribution through your IRA directly to the charity, it cannot be to a private foundation. Also, you cannot do it to a donor advised fund. So unlike when you donate cash to a donor advised fund and you get a deduction, you cannot do that, unfortunately, with a RMD distribution that goes directly to the charity. Also, you cannot do it to a charitable remainder trust or a charitable annuity. So those are some of the limitations with doing a charitable distribution from your IRA. A couple of other benefits of donating your IRA directly to the charity is that it reduces your taxable income. So if you were to take that RMD regularly, then your taxable income will be higher. But if you donate it directly to the charity, then your taxable income is lower. So obviously you pay less tax on that. But the other benefit is that if you're getting Social Security, sometimes depending on your income, your Social Security may be taxable to you. But if your taxable income is lower, now your Social Security either may not be taxed or may a smaller amount of it may be taxed. So that's another advantage of donating your IRA directly to a charity. Another benefit is, let's assume you don't itemize at all and you're just subject to you only get the standard deduction. Well, if you do the donating IRA directly to charity, you're still getting a tax benefit because your taxable income is lower, even though you don't itemize. So you get a win-win in that situation as well. Now let's look at a couple of examples. Let's assume that you're 75 years old and you have an RMD for the year of $50,000. So you have to take out $50,000 from your IRA, and you decide to donate $5,000 of that to your favorite charity. If you do that, the $5,000 of that $50,000, $5,000 would automatically go to that charity from your IRA, and then the other $45,000 would go to you. So what ends up happening in this situation is, A, you fulfilled your RMD requirement because you were supposed to take out $50,000, and that's occurred. But of that $50,000, you're only taxed $45,000 because you diverted $5,000 to your favorite charity. So you've reduced your taxable income by $5,000. Let's take a look at another example. Let's assume that you take the standard deduction on your taxes, which means that you don't itemize, and on a regular basis, you donate $20,000 to your favorite charity. In this example, by donating that $20,000, you don't get a tax deduction because, again, you're itemizing your deductions. Now, let's further assume that instead of donating cash to your favorite charity, you decide to donate a part of your IRA that you would have had to take as an RMD directly to that charity. Now, let's assume further that you're in a 30% tax bracket to calculate what your tax savings would be if you did this scenario. If you're in a 30% tax bracket and you donate $20,000, you essentially save $6,000 of taxes that you would have paid by donating the money directly from your IRA to the charity. Because in this situation, what happens is your taxable income is now $20,000 less. And if it's $20,000 less, you multiply that $20,000 times the tax rate that you would have paid, and that's what gives you the tax savings. Now, you can still do this, as I mentioned earlier, even if you don't itemize. So in this scenario, if you're not itemizing your deductions and you're getting the standard deduction, you're still getting that tax benefit of $6,000 by donating your IRA directly to charity instead of taking it as an RMD. Now let's discuss what would happen if you have an IRA that's got basis in it and taxable amounts in it. So what's the situation that would arise to an IRA with basis and taxable? It would be when you make a non-deductible contribution to an IRA and then an IRA grows. So let's assume that you made a non-deductible IRA contribution of $5,000, and now that IRA is worth $100,000. Well, you have basis of $5,000, meaning you don't pay tax on that when you take it out, but the other $95,000, which is growth, is what's called taxable, and you have to pay tax on it when it comes out. Traditionally, when you take money out of an IRA, assuming in an RMD situation, you would take that money pro rata. So every time you take money out, a portion of it's going to be considered basis, and another portion of it's going to be considered taxable. But if you donate the IRA RMD directly to charity, then the basis is ignored, that $5,000, and all the taxable portion is given to the charity. So you continue to whittle away at the taxable portion as you donate to charity, and the basis remains the same. And over time, what happens is now instead of having an allocation where it's $5,000 basis, $95,000 taxable, the basis becomes a larger percentage of the IRA, and pro rata becomes less taxable when you take it out. A couple of closing thoughts. First off, don't donate money to charity through your IRA if you cannot afford to donate that money to the charity. So obviously, if you need the money to live off of, then you're going to have to take the RMD. Also, this doesn't just apply to regular IRAs. It applies to simple IRAs, SEP IRAs, any IRA that really has an RMD requirement to it. Roth IRAs, as most of you know, does not have an RMD requirement, so it doesn't really make any tax sense to donate to charity your Roth distributions to a charity because you're not going to get taxed on it anyway. So thank you again for joining us for another edition of the ACap Recap. Hopefully this was helpful for you in determining how to donate a part of your IRA to charity and not pay tax on it. If you have a question or a comment, or you want us to cover a particular topic in the future, be sure to include it in the comment section below. And remember to subscribe, like, and share our channel.